The Financial Sense Midweek Edition with Jim Paplava. Delving in-depth with authors and experts into the key economic issues.
Joining me on the program is Nick Barisheff. He heads up the BMG Bullion Management Group. And Nick, since the beginning of the year, let's mark this year 12 that we've seen the price of precious metals go up. Gold's up about 10%. Silver's up a little over, almost close to 20%. And yet we had the sell-off as we did towards the end of the year. In many in the media, a lot of the blow dries have been telling people that the gold bull market is over. But prices are still rising, but I think there's a lot of confusion out there.
Well, there is, because a lot of times the official statistics just aren't making any sense in terms of real life. First of all, if we look at gold's performance over a period of a year, then it's up, 26% in U.S., 29 in rubles, 29 in euros, 27 in Canadian, 28 in British pounds. So it's not exactly been a bad year, even though we had that correction in the fall. But the media seems to be on this kick that everything's going, the economy is recovering, the bull market and bullion is over because there's nothing left to worry about, and so on. Where in reality, nothing's being corrected, and some of the longer-term major trends are still completely with us, like the financial crisis, the debt crisis in Europe, and the coming debt crisis in the UK, Japan, the U.S. are still very much with us. We're simply lucky that we have a preview of what's going to happen here by watching what's happening in Greece. That's what's coming down the road.
It's amazing, too, because in 2010, Congress and the President enacted a payroll reduction tax. They extended it into this year. And they talk about, Nick, they're talking out of both sides of their mouth. The Social Security trustees said it's going to go broke. Medicare is on the way to bankruptcy. And the president just proposed a $3.8 trillion budget, which we're running trillion-dollar deficits. And for some reason, we seem to believe that we're immune to things that are happening, for example, in Greece, Portugal, Italy, and other countries of the world because we're the world's reserve currency. But as I follow things around the globe, we're seeing more and more countries today, whether it's OPEC, whether it's China, whether it's Brazil, that are doing bilateral trade deals bypassing the U.S. dollar. So how long can this continue?
Well, that's the thing. Those are always difficult to estimate because they tend to continue longer than it seems rational to go on, but they do. And right now, like you've said on your program, the U.S. is the best house in a bad neighborhood. So it seems to benefit as these problems first manifest themselves in other countries. Then there's a certain amount of flight to the perceived safety of U.S. Treasuries. Like many articles on this topic, is that U.S. will likely be the last country to have a currency crisis, and the other dominoes will fall first. By seeing all this, we're only looking at the current financial debt situation in these countries. But when you look further, and I've talked about these, I think we've talked about them before, there's some irreversible macro trends that are going to make things much, much worse. And that is that over the last 20, 30 years, the economies of the Western world were driven by the baby boomers. And the baby boomers are now going to start retiring, and instead of putting money into the system, they're going to be taking out. And that's simply a fact. They're retiring at the rate of 10,000 a day in the United States. And that's going to continue, and it's going to put a huge strain on the economy, and particularly given that Medicare and Social Security and so on is bankrupt and out of money. So the amount of new money that's going to be needed to support the baby boomers is huge. And the negative effects on the economy from the point of view of reduced spending that you tend to do when you're in retirement will also exacerbate the problem. On top of that, the unemployment is not cyclical, it's systemic. And it's unlike other previous unemployments where the economy picked up, everybody got back to work. Well, the jobs have been outsourced. They're gone. They're not coming back. And this is the case in many Western economies. And if manufacturing plants do start up in the United States, they're going to be highly automated with very few employees. That's the only way you can compete with third world countries. And what you've talked about, we've talked about, the real big problem coming down the pike is peak oil. So these are things that are still to come, and we've got a financial mess as it is right now.
You wrote a piece a while back, and you've got a book coming out, and I did a piece here recently making the case on why gold prices could go up to $10,000. Now, we've seen them go up sixfold since the bull market began back in 2001. But as I look at the fundamental conditions that drove gold prices to where they are today, Nick, they've gotten even better in terms from a fundamental point of view. Governments are running bigger deficits. Central banks are engaged in quantitative easing, whether it's the Fed or the ECB or the Bank of Japan. Governments are also involved in financial repression, keeping interest rates below the inflation rate. We also have central banks that have turned into net buyers. Gold production hasn't increased to any significant degree, despite almost a sixfold increase in prices. So as I lay all that out, look at the money supply, Nick, you and I could probably spend the next hour telling people why fundamentals are getting much better. But let's see if we can just briefly outline why we think, both of us think, that we could hit 10,000 on the price of gold.
To me, what changed my mind, I kind of avoided doing predictions. I was happy that, gold price is rising, and it's a good way to protect, your existing wealth. But when that debt ceiling debate took place last year, and particularly given how many Republicans were elected by the Tea Party, it was crystal clear that there was no political will to do anything about the deficit. And it was going to keep growing and rising in excess of like $1.5 trillion a year. And, now those numbers are built into budgets for as far as the eye can see. So this is just clearly unsustainable in any way, shape, or form. Just not possible. And it would be bad enough if it wasn't for the deficits in Medicare and Social Security. But when you look at the real debt to GDP in the United States with unfunded liabilities, it's like 346%. Unheard of numbers. Unconceivable numbers, But that's what they in fact are. And they're piling up when we have these other problems like peak oil and retiring baby boomers adding to the problem. None of that's factored in. I think $10,000 is conservative because I think once you get past $5,000, then you're into hyperinflation, and what we talk about today will seem ridiculous.
It's amazing. You mentioned the debt ceiling, and that kind of struck me in the same way, that there just wasn't any political will. And you saw it happen to the Bowles-Simpson Commission. Alan Simpson, with his sense of humor, said as soon as he put it out, he immediately asked for witness protection because he gored so many sacred cows, and nobody wants to talk about entitlements, which are 65% of the budget. But here's another thing that also struck me, Nick. We're adding a little over $1 trillion and a half a year to the budget balance. We're at $15.4 trillion today. Just a simple 1% increase in interest rates. In other words, if 10-year treasuries went from 2% to 3% or even 4% like they were just 2 years ago, that would add an additional $300 billion in interest to the government's budget. There's just no way that they can afford to do this, and not one politician. I've noticed this in the presidential election this year. In fact, the president just unveiled his budget this year, and it's like, not only are they not cutting, we are cutting spending on the wars, but that money is going to be redirected for more pork and entitlements here. But the president is actually increasing spending, and the deficits are going to get bigger, and they come up with these, I don't know where they come up with these numbers, that somehow you can raise taxes by $500 or $600 billion and the economy will grow. They're using 3% growth figures for their budget deficit reduction numbers.
That's right, and you see, the growth issue, that's an important part. But if you study Greece as an example, one of the big problems is that regulatory burden, the bureaucracy, inhibits growth. Like a friend of mine was trying to do a hotel on one of the islands, and that's a great thing for the Greek economy, do more tourism on the islands. And it was 3 years and over 100 different bureaucratic approvals. And this is now what is happening in the States. Like you've talked about, it's simply building a house on rural land, what you have to go through. But it's becoming more and more the case for small business that there's too many regulatory impediments. So if you have that, then growth's not going to happen. The growth starts at the small business level.
Well, I want to move back towards gold now. We've laid out some fundamentals on one of the reasons why we think gold is going to 10,000. And you might be right, Nick. This could be a very conservative figure given the size of the budget deficits, because they're not going to get any smaller. They're going to get bigger. And you can't make them go away by wishing fictitious economic growth rates. I mean, they're talking 3% economic growth, and we haven't even achieved 3% economic growth in the last decade. The average was about 2.4%, and it's even weaker in this decade.
What if John Williams is right, and I tend to think that he is, and real inflation is 11%, then the inflation adjusting factor for GDP puts the U.S. in that clear depression. The difficulty of what numbers you use, and the media and the government are obviously using the ones with the rose-colored glasses, but in all reality, that they're just not accurate, and they're not accurate by a long shot.
You know what amazes me too when you get to these numbers is they parrot these numbers, and the media has fallen on its duties, in my opinion, by not calling these numbers into question. I mean, they simply parrot the numbers the government gives them when they've got to know, Nick, when they go into a grocery store, pay their medical insurance premiums, any kind of services they employ, or go to the grocery store or put gas in their tank. They obviously have to know that these numbers are fictitious, and yet they report them like they're gospel.
That's true. Our VP of Business Development, when he does a seminar with a group of investors or advisors, he asks in the audience if anybody here believes that inflation is really 2%, and nobody raises their hands. Like everybody understands that it's much higher than 2%.
I want to move back to bullion and contrast fiscal bullion, because I could foresee a day, Nick, where it's going to be hard to get your hands on it. And for many people, it's going to be unaffordable. I mean, if you're talking about how many people will have the ability to buy a $10,000 1-ounce maple leaf or a gold eagle. But let's contrast, especially given what happened with MF Global, some of the ETFs like GLD and SLV versus owning bullion outright. And what would you say the risk is to, let's say, owning the ETFs? Seems at the top would be counterparty risk.
Well, that's right. We have to, first of all, separate. Oftentimes the ETFs are lumped in together. So there's a big difference between a closed-end exchange-traded fund and then an ETF like GLD and SLV that uses authorized participants. World of difference. The problem comes in with the authorized participants, where most of the people, like very sophisticated analysts and chief investment officers of major funds, clearly have not read the prospectus. And the difference is it's not like an open-end mutual fund where investors send the money to the fund manager. Manager buys the bullion, and you go from there. You have authorized participants contribute baskets of assets to the ETF. The ETF gives them shares, and they sell the shares to the public. That's the mechanism. The question you have to ask yourself is, why do the big Wall Street banks want to do this? Why would I want to go out in the market and buy assets, contribute them to the ETF at NAV, get shares at NAV, sell them to the public at NAV? Okay? Doesn't make any sense.